Right now, central banks around the world are doing something they haven't done at this scale in over 50 years. And if you're not paying attention, the window to protect yourself may already be closing. They are buying gold, not slowly, not cautiously, aggressively, strategically, and in record-breaking quantities. The question you need to be asking yourself is not whether this is happening. The question is, what do they know that you don't? So in this video, we're going to separate what's real from what's just hype. By the end, you'll walk away feeling calmer, clearer, and far more confident about what you're actually buying, and more importantly, why you're buying it. Drop a comment below and let me know the exact day and date you're watching this from. I love seeing where and when you're tuning in. And real quick, if you appreciate content that's built from scratch, thoughtfully researched, and never copied, support the channel by subscribing and commenting Henry's Market HQ below. It helps this channel grow more than you think, and I truly appreciate it. Let's start with a number that should stop you in your tracks. In 2022, central banks around the world purchased over 1,136 metric tons of gold. That is the highest level of central bank gold buying ever recorded in modern history, surpassing even the purchases made during the height of the Cold War. And then in 2023, they did it again, buying another 1,037 metric tons. 2 consecutive years of record or near-record gold accumulation by the most powerful financial institutions on the planet. These are not small hedge funds making speculative bets. These are the institutions that literally print and manage national currencies. When they start hoarding a physical asset at this scale, that is not a coincidence. That is a signal. To understand why this matters so deeply right now, you have to go back to 1971. Before that year, the United States dollar was directly tied to gold through what was known as the Bretton Woods system. Every dollar in circulation was technically backed by a fixed amount of physical gold held in reserve. The system gave the dollar its credibility, its stability, and its global trust. Then President Nixon made a decision that changed the entire global financial architecture. He ended the dollar's convertibility to gold, effectively severing that relationship permanently. From that moment forward, the US dollar became what economists call a fiat currency, meaning it is backed not by any physical commodity, but purely by the government's promise and the collective confidence of the market. Now, for a few decades, that system worked relatively well. The United States had the largest economy in the world, the deepest financial markets, and a military presence that reinforced dollar dominance globally. The dollar became the world's reserve currency, the standard used to price oil, commodities, and international trade. But here is where the story starts to fracture. When a currency is no longer tied to anything tangible, it can be created in unlimited quantities. And over the past 2 decades, that is exactly what has happened. The US money supply, measured by what economists call M2, was approximately $4.6 trillion in the year 2000. By early 2022, that number had exploded to over $21 trillion. That is not economic growth. That is currency expansion on a scale that fundamentally changes the math of money itself. What happens when you dramatically expand the supply of anything? Its value per unit goes down. When more dollars exist in the system chasing the same amount of goods and services, each dollar buys less. That is inflation, not just rising prices, but the quiet, steady erosion of your purchasing power. And the people who feel it first and hardest are not the wealthy. They are everyday Americans, the family trying to afford groceries, the worker whose paycheck no longer stretches to cover rent, the retiree watching their savings slowly lose ground against rising costs. This is not abstract economics. This is happening right now in real households across every income bracket. So where does gold fit into all of this? Gold has been used as a store of value for over 5,000 years, not because of tradition or nostalgia, but because it has properties that no paper currency can replicate. It cannot be printed. It cannot be digitally created. Its supply grows by less than 2% per year through mining, which is closely in line with sustainable economic growth. Unlike dollars, euros, or yen, gold does not lose value because a government decided to run a larger deficit or fund a new spending package. It sits outside the monetary system, and that independence is precisely what makes it valuable as a hedge against the system's failures. Central banks understand this better than anyone. When they buy gold, they are not making a short-term trade. They are making a long-term statement about the future credibility of paper currencies. They are diversifying their reserves away from assets that can be inflated, frozen, or weaponized through sanctions. Following Russia's invasion of Ukraine in 2022, the United States and its allies froze approximately $300 billion in Russian central bank assets held in Western financial institutions. That event sent a shockwave through the global financial community. Countries that had previously held the majority of their reserves in dollars and U.S. treasuries began quietly reconsidering that strategy. If your reserves can be frozen with a phone call, they are not really yours. Gold held domestically cannot be frozen by a foreign government. It cannot be sanctioned. It cannot be digitally erased. That realization accelerated the gold buying you see happening today. China, Russia, India, Turkey, Poland, and Singapore are among the nations that have been adding gold to their reserves at the fastest pace in recent history. China alone has reported gold reserve increases for 18 consecutive months, and analysts widely believe the actual numbers may be significantly higher than what is officially disclosed, because China has historically underreported its gold holdings before making large public announcements. The pattern is clear, even if the full picture remains deliberately opaque. If this is making sense so far, go ahead and hit that like button. It genuinely helps this channel reach more people just like you. Here is where the story gets deeper, and where most everyday investors are completely left out of the conversation. While central banks have been aggressively stacking physical gold, the mainstream financial media has spent most of the past decade telling retail investors to stay focused on the stock market, on index funds, on real estate, and on the promise of continued economic growth. And for a long time, that message felt justified. Markets went up. Real estate appreciated. The economy, at least on paper, looked healthy. But underneath that surface, some very serious structural cracks were forming. And the people who saw them earliest started moving into gold long before the headlines caught up. One of the most revealing indicators is what is known as the gold to S&P 500 ratio. This ratio compares the price of gold to the value of the S&P 500 index and gives investors a way to measure which asset is gaining real ground over the other. Over the past few years, gold has been quietly gaining on equities in ways that have not been widely publicized. In early 2024, gold broke through the $2,100 per ounce barrier for the first time in history, then surged past $2,400 and continued climbing in ways that surprised even seasoned analysts. Meanwhile, the stock market, while still nominally high, has been increasingly propped up by a narrow group of mega-cap technology stocks, a concentration of performance that historically signals fragility, not strength. And this is where most people stop reading, stop watching, stop paying attention. But the ones who stay are about to understand something that could completely change how they see their money. The real inflation rate, not the official number published by the government, but the rate that reflects what ordinary Americans actually experience at the grocery store, at the gas pump, at the doctor's office, has consistently run higher than the Consumer Price Index suggests. Economists and independent analysts who use the methodology the U.S. government employed before 1980 estimate that true inflation has been running anywhere from 8 to 15% annually in recent years. That means if your savings account is earning 3% interest, you are not growing your wealth. You are losing it, silently, steadily, and legally. Every year you hold cash in a low-yield account during a high-inflation environment, you are effectively paying a hidden tax on your own savings. Gold, by contrast, has maintained its purchasing power over centuries. An ounce of gold purchased roughly the same amount of goods in ancient Rome as it does today, adjusted for the goods available in each era. No paper currency in history has ever made that claim. Now consider the bond market, which for decades served as the safe haven alternative to stocks. When stocks fell, investors fled to bonds. That relationship, known as the negative correlation between stocks and bonds, was the foundation of the classic 60-40 portfolio, 60% stocks, 40% bonds. But in 2022, something historic and deeply unsettling happened. Stocks and bonds fell simultaneously. The 60-40 portfolio recorded one of its worst years in a century, with some configurations losing 20% or more of their value. The safe haven failed. The hedge didn't work, and investors who had been told for decades that bonds would protect them during downturns were left with no shelter. Central banks noticed. Individual investors who were paying attention noticed too. Gold, in the same year, held its value far better than both asset classes, and has since dramatically outperformed both. There is also a currency dynamic unfolding on the global stage that deserves far more attention than it receives in mainstream financial coverage. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with new members like the UAE, Egypt, Ethiopia, and Iran, have been actively discussing the creation of a new reserve currency system that reduces dependence on the US dollar. While a formal BRICS currency has not yet been launched, trade between these nations is increasingly being settled in local currencies, and in some cases, gold. The share of global trade settled in dollars has been declining gradually but consistently. If that trend accelerates, the demand for dollars as a reserve asset declines, and the consequences for dollar-denominated wealth are profound. What is particularly striking is the timing and coordination of central bank gold purchases relative to these geopolitical developments. Countries that have the most to gain from reducing dollar exposure are precisely the ones buying gold at the highest rates. This is not random diversification. This is deliberate repositioning for a financial world that looks structurally different from the one we have operated in for the past 50 years. And the average American investor, watching the daily noise of stock tickers and interest rate announcements, is largely unaware that this repositioning is happening at all. The global debt picture adds another layer of urgency. Total global debt now exceeds $300 trillion, a number so large it is almost impossible to conceptualize. The United States alone carries over $34 trillion in national debt, with annual interest payments now exceeding $1 trillion for the first time in history, surpassing even the defense budget. When a nation's interest payments outpace its ability to grow its way out of debt, the historical playbook has almost always involved one of two outcomes: default or inflation. Outright default is politically unthinkable for a major economy. Inflation, on the other hand, is quiet, gradual, and far easier to implement because it reduces the real value of debt without anyone officially admitting it. Central banks know this calculus intimately. Their gold purchases reflect a clear-eyed understanding of which direction this story is heading. This brings us to what every viewer watching this video needs to understand as we move into the next phase of the global financial cycle. The resolution most investors are looking for is not complicated, but it does require a willingness to see the financial world clearly, without the filter of optimism that Wall Street sells, and without the paralysis that financial fear can create. The answer is not to panic. It is not to liquidate everything and hide in a bunker. The answer is to reposition thoughtfully, to understand what your money is actually doing, and to protect the purchasing power you have already worked so hard to build. Gold is not a get-rich-quick scheme. It is not a speculative asset like a meme stock or a cryptocurrency with no underlying value. It is a store of value, a financial anchor in a world where the currency system is under genuine, measurable strain. So what does that actually look like in practice? The first actionable step is to honestly assess your current portfolio for real inflation exposure. Look at what percentage of your wealth is sitting in cash, savings accounts, or low-yield bonds. Assets that are actively losing ground to inflation every single year. Even a small reallocation toward inflation-resistant assets like physical gold or silver can meaningfully change the trajectory of your long-term purchasing power. Many credible financial advisors, including those aligned with institutions like the World Gold Council, suggest a 5 to 15% allocation to physical precious metals as part of a diversified portfolio. That range is not arbitrary. It reflects decades of research on risk-adjusted returns during periods of monetary stress. The second step is to distinguish between paper gold and physical gold, because they are not the same thing, and that distinction matters enormously. A gold ETF, or exchange-traded fund, tracks the price of gold and offers easy liquidity. But it is a financial instrument. It is a promise on paper. If the system that supports that paper instrument comes under severe stress, your ETF does not give you the same protection as holding actual physical metal. Physical gold, coins, bars, bullion, held in your possession or in an allocated insured storage facility, gives you direct ownership of an asset that cannot be diluted, digitally erased, or frozen by a counterparty. Many of the central banks buying gold today are specifically repatriating their physical holdings and bringing them back within their own borders. Germany brought back 300 tons of gold from the US Federal Reserve. Poland added over 100 tons to its domestic reserves. They are not buying ETFs. There is a lesson in that choice. The third step is to stay educated and stay consistent. Markets are noisy. Every week there will be a new headline telling you that gold is overvalued, or that the dollar is fine, or that inflation is under control. Some of those headlines will be true in the short term, but the long-term structural forces driving central bank gold purchases, currency debasement, global debt expansion, geopolitical fragmentation, and the slow erosion of dollar dominance do not reverse overnight. They unfold over years, sometimes decades. The investors who have historically benefited most from gold are not the ones who tried to time the market perfectly. They are the ones who understood the thesis, held their position with conviction, and did not allow short-term price volatility to shake them out of a long-term strategy. I want to be clear, I'm not here to sell you anything. I'm here because this information changed the way I think about money, and I want it to do the same for you. The wealth transfer that Lynette Zhang and other credible financial educators have been warning about is not a theory. It is visible in the data, in the purchasing behavior of central banks, in the price action of gold across every major currency, and in the quiet repositioning of institutional money away from traditional paper assets. The people who act on this information thoughtfully and early will be in a fundamentally different financial position than those who dismiss it as noise and continue doing what they have always done. Your financial future is not determined by what the market does. It is determined by how clearly you understand what is happening, how honestly you assess your own vulnerabilities, and how deliberately you choose to protect what you have built. The fear of debt, the confusion around investing, the desire for real financial freedom. Those feelings are valid, and they are shared by millions of people right now. But fear without action changes nothing. The information in this video is not meant to overwhelm you. It is meant to give you a foundation, a starting point for smarter, more confident decisions about the money you work so hard to earn. Central banks are not infallible. They make mistakes. They operate with political pressures and strategic interests that do not always align with the public good. But when institutions of this size and sophistication move this decisively into a single asset class, it demands attention. It demands that you ask why. And it demands that you take an honest look at whether your current financial strategy is built to survive a world where the rules of money are quietly but fundamentally changing. You now have the context, the data, and the framework to start thinking about this differently. The next move is yours. If you are benefiting from our topics, please subscribe, like, and turn on the bell notification so you can see our new videos early.